Another Fed rate hike. We saw it coming, everybody, didn't we? Interesting question that I want to explore on today's video, right? What are 4 things that will be more expensive after this recent Fed's rate hike? Because Federal Chair Jerome Powell came out again recently announcing a 3rd consecutive rate hike of 75 basis points in an effort to curb inflation. The increase will push up borrowing costs even more on your credit cards, on your auto financing, and on other loans. This year's 5th hike in the Fed funds rate brings it to the 3 to 3.25% range. It's the highest since 2008 now. Normally, interest rate increases are made in the 0.25% increment, but the Fed has been using an extra large increase to rein in inflation, which is now running at 8.3% year over year, far higher than the benchmark target of 2%. By raising the policy interest rate, the central bank is discouraging spending, which could lower the price inflation for goods and services. However, the drawback, of course, of every interest rate increase is higher monthly borrowing costs for Americans. In today's video, I want to take a closer look at 4 different things that are about to become more expensive as a result. Number 1, mortgages. If you have a fixed rate mortgage, rising rates have no effect on your existing loan. However, if you are getting a new mortgage, considering refinancing or purchasing something, or if you have an adjustable rate mortgage on your loan now, then your monthly payments might rise. Mortgage rates generally rise when interest rates increase, but are affected more directly by the bond market. Since the beginning of 2022, mortgage rates have gone up from 3% to over 6%, increasing monthly payments for a 30-year fixed rate mortgage of, call it $400,000 with 20% down, by a massive $569 every single month. Now, one silver lining here is that the recent widely anticipated interest rate hikes may have been baked into the existing mortgage rates, meaning that based on the Fed's recent statement, they may not rise a whole lot further, fingers crossed. Mortgage rate predictions for the rest of the year are a mixed bag, with many suggesting that rates will flatten out. Even so, obviously, we have to agree that gone are the days of cheap mortgages that we had grown so accustomed to. Expect mortgage rates over 5% for the next couple of years at least. Now, with rates that high or even higher, it'll be more important than ever to implement a solid debt reduction plan for yourself, for your non-mortgage related balances, and possibly even your home loans. In a recent video, we outlined the pros and cons of paying off a mortgage early. Be sure to check out that video to find out if an accelerated mortgage payoff strategy would be potentially a good fit for you and your financial goals. Make sure you're a subscriber here, because we are going to be giving away free coaching sessions again, and perhaps we can dive into your circumstances more specifically. Number 2, credit cards. Guys, these things are just plain nasty. You should not be spending any money on interest on credit cards. And here's the thing, the Fed interest rate increases will impact your credit card's APR, which is known as your annual percentage rate. That determines what you will pay in interest on any outstanding balances that revolve at the end of each month. This is why it's so important to pay these to zero. When rate increases began at the beginning of 2022, average APRs were near 16%, and they've since increased now to slightly above 18%. With the most recent increases, the average APR on a credit card may hit even closer to 19%, according to bankrate.com. In this scenario, for a $5,000 balance where you have an APR of, say, 19%, you're going to pay $1,197 more in total interest costs than a rate of 16% if you only pay the minimum monthly payments. And that, folks, is just with a $5,000 balance. $1,100 more. Now, that said, if you are following the practices that we teach here on the channel, you shouldn't actually be too concerned with these interest rates, especially when it comes to their outrageous costs when only making minimum monthly payments, because we pay these things to zero every month, which means we always enjoy 0%. The third is your auto loans. The Fed's interest rate increase does not affect those that have that fixed rate auto loan in an amortization schedule that they're already paying on that's in place. However, they do increase the interest costs of new auto loans or auto loans that have that adjustable rate type of financing. As of early 2022, the average new car loan interest rate was 3.85%. That was amortized over 60 months or 5 years. But with the recent interest rate increase, that rate is likely to move up to somewhere between 5.5% and 5.75%, almost a 2% increase. And that works out to roughly $31 every month in monthly auto finance payments on a $35,000 vehicle. Prices on new cars remain near their all-time high still, as you've probably noticed, with the average new car price now hitting a $48,000 level according to Kelley Blue Book. Used car prices have been outrageous ever since the pandemic hit and supply chain issues, but the good news is they're finally starting to come back down. With that being said, overall, used car prices are still 20% higher than they were last year. With the high prices, higher interest costs for new cars, I certainly don't envy anybody in the automotive market right now. The fourth and final thing on our list will be other variable rate loans. Expect increases as well in costs for adjustable rate loans of any kind, including home equity lines of credit. In early 2022, the average rate on a HELOC was over 4%, but the rate has since increased to 6.51% with the most recent Fed rate hike. Average rates may rise to even as high as 7.25%. Home equity loans were at 5.96 earlier this year. That's the amortized version of a home equity line of credit. They're currently around 7%, so a little over 1% higher, but they could be nudged up to even closer to 8%. How much you pay will obviously vary widely depending on your lender, your loan size, and your credit scores. Those will always matter. Optimizing your credit score is one of the best ways to ensure that you're able to acquire the best lending tools, or what we call debt weapons, at the lowest rates possible. And there are many ways to optimize your credit score. We've made many videos on this subject. I'm specially trained in this subject and have been for the last over 20 years now. So be sure to check out the playlist below in the description. In that playlist, you'll find everything you need to know about building and optimizing your credit scores. Beyond credit scores, doing your due diligence before acquiring new debt is absolutely essential. When it comes to getting the best borrowing tool, the best loan, the best banking relationship, it's going to boil down to specific purposes. We did put together a cheat sheet for this. We call it the Debt Weapon Cheat Sheet. It's specifically for this purpose. It's a gift to you on YouTube, our audience members. Make sure you check the description below. It's completely free. Will you be affected by this rate hike? I'm curious. Let us know in the comments. What loans are you borrowing where you're going to start to see an impact in your payments every month, and how will that affect your cash flow each month? If you're not making any more money, but you're spending more on outstanding balances or on expenses every month, it certainly leaves you less at the end of the month. And that is the net outcome to your cash flow. And cash flow equals choices. Cash flow equals freedom. Freedom of choice equals financial independence. This is what we're all after. Maximizing cash flow is absolutely critical. You've got to keep an eye on it. So use the cash flow cruncher, use the debt weapon cheat sheet, try to spend as little as you possibly can on these costs of interest, and try to have as little debt, or your debt managed as well as it can be. Right now, you are going to, it may mean the difference between financially getting ahead or costly mistakes that create years of setback for you. With that being said, I hope to see you on the next video. Become a subscriber if you're not one already. Drop a like for us. It helps the algorithm so much. Until we see you on the next one, make it a great day and keep on cash flowing. Take care.